Hello and a virtual welcome from St. Mary's College. Thank you for joining us this afternoon for our seminar, Managing Your Finances Through the Pandemic. I'm Courtney Bennett with Office of Plan Giving at St. Mary's College, and we're co-hosting today's event with the Office of Alumni Engagement. During these troubled times, our core values can provide comfort, and having a strong community is proving critical. We can also find some relief in getting information that will help us to manage through this pandemic. And that's what we hope to accomplish today. St. Mary's College wants to be a trusted source of information, and one of our core values is creating learning communities based on mutual respect and understanding. We're grateful that you're part of today's learning community and that we have an experienced and knowledgeable presenter to help guide us through the financial implications of this crisis. I will turn the program over to my colleague, Mary Poppingo, Vice President for Alumni and Community Engagement, who will introduce our speaker, George Noceti. But a quick program note that the format of this seminar doesn't allow time for Q&A. So I'm going to send a follow-up email with George's contact information for those of you who want to contact him directly. Thank you.
Thank you, Courtney. For more than a decade, George Noceti has been serving the needs of individuals and families by developing financial plans to help manage their present situation and to plan for future dreams and aspirations. In addition, George is a chartered retirement plan specialist and has provided advice and guidance to employers offering defined benefit and defined benefit contribution plans. Prior to joining Morgan Stanley, George held a variety of leadership positions, such as the Chief Operating Officer at Match.com and the school principal in the Richmond Unified School District. George received his MBA from St. Mary's College in 1984, and he also holds a master's in education. You may have heard or seen George on either ABC or KRON, maybe KTVU, or even KGO radio, as he is a frequent contributor. We're thrilled that you're with us today, George, and I'd like to turn the video and the screen over to you. Thank you for joining us today.
Well, Mary and Courtney, thank you very much for the very kind introduction. It's almost like I wrote it myself. Thank you very much. It was great. I think this presentation will be informational and helpful to all of you. We've experienced pandemics before over the years. We've recovered from them. This one's a bit different. The healthcare risk that we have has really morphed into a financial risk, and the financial risk is morphing into a political risk. We have an election coming up in just 5 months, and it's going to be the coronavirus and politics 2020. And those are major risks that impact our economy and impact the stock market. On top of that, it's important, I think, that we mention that we also have another risk out there, and that's a social risk. The racial inequality that we've seen over the many, many years is manifesting itself right now. And so I think we have to acknowledge that this is a risk, and we have to, have our prayers and our feelings out for people that are really suffering underneath that. So with that, I'm going to take a moment to transition to the visuals that you'll be seeing. So just give me one moment to do that. Very good, everyone. Well, thank you and welcome to Managing Through the Coronavirus Crisis. I'm going to cover 5 important key points during the presentation. The first one is we're going to get a baseline of what's happening with COVID-19 today. Second part of the presentation is what's happening with the economy. The economy is doing poorly. So the third part will be the stock market, and why is that doing so great? We're going to try to explain the differences between the economy and the markets and explain what's going on. And the fourth section of the presentation will be the government's response and what that really means to you as an individual or a business person. And the fifth one is kind of the finale. There is a path forward, and we're going to discuss that, maybe some corrective actions that you should think about and take a look at within your portfolio. Just quickly, the next slide that you're going to see is very fine print, very hard to read. I'll explain what that is. Working for a financial services firm, we're highly regulated, and we need to have a disclaimer. This basically says that we're going to give you information that's important, but you shouldn't necessarily rely on it for your own investment decisions. What you should do really depends on your own personal situation, and this is really important when you get advice from people. What's the best thing for you to do? So with that, I'll just quickly mention again that I'm George Noceti. I'm a family wealth advisor with Morgan Stanley in Walnut Creek, and our practice focuses on financial planning and education first. We think that's the most important thing, investing second. If you have a good plan, your investments will work for you. People that really do good planning and strategic investing, they just do better when they combine both together. My business partner is Paul Noceti. He's a mechanical engineer through his education, and he was brought on about 10 years ago for succession planning. He adds a lot of value. That means that one of us can do math now, which is really good. And a lot of our work that we do is quantitative, besides the educational seminars and information that we put out for people. So let's take a look at part one first. Let's just cover the baseline, what's happening with COVID-19. So this is an important slide, and this is depicts a website that was put together by Johns Hopkins University Hospital. And this site came up, it was developed actually by a high school student who was really smart. And this site collects all kinds of information about COVID-19 and its effect on various countries and populations, and really illustrates the curve. Every economist looks at this site, individuals look at this site, and the map can be drilled down on and can give you individual information to really show you how things are going. So I would suggest taking a look at it when you have time. It's very, very helpful. So the current areas of concern that you'll eventually see when you go to this site is the tri-state area. And that would be in the East Coast, especially New York and the West Coast. The concern is that many people who have the virus have not shown any symptoms and have not been tested, meaning that there are more cases than have actually been reported. In addition, recent studies suggest that significant portions of the population have been exposed to the virus and have not shown symptoms yet. Current estimates are anywhere from 10 to 30 times more. And I think it's going to be very interesting. We just had Memorial Day come up, and we saw tons of people gathered together without masks. And of course, now we have demonstrations, and we see literally hundreds of thousands of people in the United States close together, some with masks, some without masks. And it'll be interesting to track now to see if the COVID-19 actually accelerates. It'll be interesting if it does not. That would be an indication that the virus is dying out for now, and that really merges with people's interest in getting back to work. The next slide, you're going to see how these cases really start to multiply. The United States has over 1.5 million cases of COVID-19. This is the most of any country in the world. New York has become the new epicenter for the pandemic in terms of the rapid spread of the infection. Generally, the US is reporting over 29,000 cases per day as a result of the increases. The US has surpassed every country and now has more cases than Spain, Russia, the UK, Brazil, India, and France combined. The important thing to really consider in the scenarios that I've just mentioned is not how much the virus will spread, but how we will spread, how we will respond to this. Currently, the US is trying to establish reopening policies that are getting people back to work. One thing we know, however, is that what is good for the economy may not necessarily be good for our health, at least in the short term. The danger we have right now is that some states may reopen prematurely or without appropriate regulations, and then the economies will shut down again, creating an increasing of crisis of confidence, among other things. So in this getting back to work now that we're starting to see, it's really important that we hedge our risk. The virus is still there. As individuals, we have to keep in mind that we have to distance ourselves, wear our masks, wash our hands, do all the things that we're told to do, and we cannot let down doing that. Businesses, on the other hand, have to do the same. They have to have a coronavirus overlay if you're going to go into a retail store or a shopping center or at any place. And this is the only way we're going to help to keep the spread of this virus down until there is a vaccine. Let me just click to the next slide here. So as the crisis continues, COVID-19 cases, we're finding that's decreasing overall. If we go back to the map here on the screen, we'll see that cases are decreasing across the nation. Even where COVID cases are rising, in such states, they have lower than previous increases. So we're seeing an overall decrease, which is good to see. But some states have higher death rates than others right now. Most coastal states have death rates slightly higher than the average, and that's because we on the West Coast and on the East Coast, we just tend to travel more. We tend to go overseas more. We tend to go to developing countries where there are a lot of viruses that are prevalent there, and we bring them back there. So we just tend to have more of this out here in our particular area. But highly populated areas such as New Jersey and Pennsylvania and New York have significantly had more deaths than usual. And of course, Los Angeles in California is another big target. However, states are beginning to lift restrictions. Nearly all states have seen a decline in the percentage of people testing positive. 14 states have declining portions of people testing negative, but we still have greater than 10% of the cases showing positive, with Maryland and New Jersey having more than 20% of the cases showing positive. But can we really move on? Well, in regard to the number of confirmed cases, there has been a significant increase over the past few weeks. And this is likely in part due to increases in testing. However, it is still cause for concern as the increase makes it likely that businesses will close if that continues. Unfortunately, testing is easier said than done. Many states lack a robust testing program, and certain medical experts say that the US needs levels of testing that are roughly 4 times what exists right now. Moreover, testing is not entirely accurate, and health experts say that they now believe nearly 1 in 3 patients who are infected are nevertheless getting a negative test result. So if we are going to venture for our homes, if we are going to get the economy going again, we have to hedge this risk individually, and businesses have to do the same. So let's go to part 2 now, which is really what is really happening in our economy right now. And we're going to talk about 2 things. Part 2 is really the economy, and part 3 is the market. So the economy and market are 2 different concepts, and this is what kind of confuses people. The economy and how we look at it is what's happened in the past. And we look at those indicators. The stock market, which we're going to cover in the next section, looks forward. And that's why you can see an economy where our numbers are really bad, which I'll go over. And you can see a stock market, which has been euphoric because it sees a path forward. And I'll cover that in detail also. So to begin with, we have an unemployment rate, which has been listed at about 14.7%. Really, it's about 20% unemployment, with really more than 40 million people unemployed. Just 3 months ago, we had full employment. So this is a dramatic shift. And the groups that have been affected mostly through this are women. Women were really 51 of the working population just a couple of months ago. And many women have been laid off, a greater majority. And we see a lot of ethnic minorities also whose unemployment numbers were getting better over the past few years. And so, and low income people. So these are the groups that have been really hit the hardest. And this is really an issue because also of the 40 million people that have been laid off right now or unemployed, most of them do not have health care, which is going to bring a spotlight to that fact of having health care for most of the people in the United States. So this unemployment rate is really bad. At Morgan Stanley, we believe by the end of the year, about half of those people will be getting back to work. Most of them have been furloughed. They're in technical jobs, jobs that are really important to keep the economy going, and they'll be the first to get back. And so that'll probably lower our unemployment rate by the end of the year, arguably from 20% to hovering about 10%. So the economy's getting hit, as all of you know, but some industries are getting hit more than others. Hospitality industries such as sightseeing, amusement parks, and gambling have been hit the hardest and have really been affected by the stay-at-home orders. Leisure and hospitality have lost about 7.65 million jobs. It's going to take a while for these industries directly affected by COVID-19, including hotels, restaurants, transportation, to really recover. Those are going to be the last ones to come back. In addition, consumer spending is less. Interesting enough, last week, we came out with reports showing how people's incomes have actually increased. This is due to the stimulus program. This is due to people just there's no place to go, no place to spend our money. So we're seeing that consumer spending is down, but income is up. And retail sales, because we can't get out there, is also down. So U.S. consumer spending has dropped significantly in March and is currently down about 7.5% month over month, and is really down the most since 1959. So what does this really mean? Well, this reflects how stay-at-home orders and job losses have significantly hurt the US consumer spending, which will in turn harm the United States gross domestic product and overall economy. And even online retailers rather, whose sales have increased, they'll be hurt by a drop in consumer spending. And so this is really important to consider, because in the United States, consumption spending is the main driver in our gross domestic product. Spending is 75% of our gross domestic product. And the key factor in getting people to spend is confidence. If confidence is down, spending stops. The University of Michigan puts out a consumer confidence and sentiment report every month, which I watch, and this is down about 20 points from where it was at the peak. So people have money to spend to stimulate the economy, but until they feel comfortable going out, interacting, negotiating for prices, buying things, it's going to have a direct effect on our economy. So it's really important that we protect ourselves, and businesses show that they're doing the same, and that we find a vaccine that will then increase confidence. Now, I mentioned that retail sales has plummeted, and year over year, we've seen a decline of 21.6%. And that's huge. The economy has also seen an 89% decline in apparel sales. Well, that makes sense. We're all in sweats and t-shirts right now. And a 59% decline in restaurant sales. So this is really significant and widespread for our economy. So consumer spending down, but where is it really down? Well, many businesses have been forced to close, as we all know, due to shutdown orders, or have simply been unable to operate as normal due to social distancing guidelines. If you look at the chart, you'll see that clothing has been hit the hardest by COVID-19, with sales down nearly 90%. There are similar yet less severe numbers in furniture, electronics, restaurant spending, as people are leaving their homes less. People are spending more time at home, as you know, so grocery sales have increased, and and gardening sales have also increased. We're at home, we have nothing to do, we start fixing up our house and our gardens. So how does this all come together? Well, it comes together in our report card, and that's called the gross domestic product. And technically, we are in a recession if we have 2 quarters back to back that are negative. So the first quarter gross domestic product, which is our report card, that was down 4.8%, first 3 months of the year. That doesn't tell the true story, because January and part of February, our economy was full go until we found sight of the coronavirus. But in the second quarter, where we have the full brunt of staying at home and not spending money, we expect this to be a terrible quarter the next 3 months. And we expect the gross domestic product to be down maybe as high as 38%. That's never happened before. But then, of course, as we start getting more towards a recovery, we have all this pent up savings, and we're going to see spending that starts to matriculate itself out in the third quarter. And the third quarter gross domestic product, we're expecting to hover about 20%. That doesn't get us to whole, but it's a step in the right direction. And the fourth quarter, we'll see kind of a similar result. So basically, our economy is not going to do that well this year. We're in a recovery mode right now. We've never had a recession happen this quickly, and we expect in 2021 for our numbers to get better, but we're working now on the fundamentals to try to make this all happen. Now, I will move quickly to China, and it's important that we kind of talk about them as an example quickly, because they are the second largest economy in the world, not far behind the United States. So China's gross domestic product has shrunk for the first time since it began reporting their GDP in 1992. This indicates that China's attempt at recovery have not been completely successful. China uses extreme measures to prevent GDP contraction, such as building all these empty cities that we've seen in the past. The fact that China's GDP has contracted is concerning, because it affects our global economy. And it's also showing that their shutdown hasn't really solved all their problems. And this is a pandemic that's created a lot of structural issues for them, as well as us and the rest of the world. So the question is, why all the stimulus for small business? Well, businesses with less than 500 employees account for, and this is important, 47% of the labor market, and contribute about 44% of our gross domestic product. This is an issue because small business employees are affected by COVID-19 more than larger businesses, since small businesses are less likely to offer paid sick leave and medical benefits. Small businesses are also more affected by COVID-19's economic shutdown, as they often have smaller margins and less cash saved. This is evident from the fact that 50% of small businesses cannot survive more than 3 months with no sales. So what does this mean? This is the reason why the CARES Act does so much to help small businesses. Yes, it's late in getting money. Is it enough money? We're not sure. We're going to find out as we go through this. Small business is a vital part of our economy, and their vulnerability is important. That can move us from a recession to a depression. So the CARES Act, which I'll cover in a moment, provides a lot of funding for this. So COVID-19 has really, hurt businesses, as you all know. It's affected virtually all businesses. It's even affected Amazon. Currently, hospitality, as I mentioned, has hit the hardest as people cancel reservations and cities such as New York shut down the restaurants. Larger businesses, though, are able to offer paid leave or rely on profit margins. Smaller businesses do not have this capability due to thinner margins and smaller cash reserves. So we would think that working from home is a solution and an easy fix, but it's really not. There's only about 30% of the workers can actually work from home, and this is via the Bureau of Labor Statistics. However, this has been a kind of a science experiment where everybody has been ordered to work at home, and this is showing employers that many more people can, and this will create some efficiencies for business as more and more people are able to increase this number from 30% to perhaps a bit higher. So what's really happening, especially for the people that are less economically advantaged, when their paycheck stops, they have no money. And we caution people in financial planning all the time to have a reserve, to try to put some money in a little security basket. It could be $5 a month. It could be $500 a month. It could be whatever you can afford. But the more money that people can put into savings is really a hedge against a risk like this. But it's not our first rodeo. It's not the first time this has happened. We saw the fires in Santa Rosa. Those people got hit pretty hard. They needed some cash reserves. We've had earthquakes in San Francisco. We've had floods. These are really teaching moments for all of us regarding of our economic wealth to have some reserves put aside. The last thing we want people to do to fund themselves and bridge themselves during this time when jobs have been lost is to take money out of their retirement accounts. But you can do that now. The law allows you to do that without penalty. So it's really important that everybody, all of us, just think about what are our basic needs. That's what we should really be spending money on. And our things that are less important, that are extra things, could be even a gym membership, which is hard to get rid of. We should really think about the long term and how we can really reduce our expenses so we can weigh this thing out. Hopefully it won't be long, but if you're in it, it's long and it can hurt. The market is starting to recover, right? Well, isn't that bizarre? Because the economy really is not. The economy is working towards getting to recovery, but it's really not there yet. We don't see the numbers to really prove that, but the stock market has. So let me just give you a couple of themes here that are interesting to think about how we can give perspective on COVID-19 and this recession. The average length and recovery time for a bear market, which we're in right now, is largely based on its cause. So there's really three kinds of causes that can occur, and we'll try to define which cause we're in. The first cause is a structural cause. This happened in 2008 when the banks failed. This is a structural cause that's serious, and the recovery time on that on average is about 42 months. And then there's cyclical causes of a recession, and this could be because businesses in the United States are expanding or contracting, and certain sectors of the economy are going to do better than others. When we have a cyclical change, that recovery is really about 27 months on average. And then we have what I think we're in right now. I would call it an event-driven bear market. We didn't do anything wrong. The economy was doing well. We had 114 straight months of job growth. Unemployment was at a record high. Wages were starting to go up marginally, but they were going up. And then all of a sudden, we have a healthcare risk. That's an event-driven risk. So we've had these before, and when we've had event-driven risk, the recovery time is really about 9 months. And that's why many people think that recovery will be a lot quicker than we think it's going to be. So while our current bear market is event-driven, it might not remain that way. It could change. If we're not able to contain the virus, then it could move into more of a structural change. But right now, we think it's an event-driven change. We think the recovery, everybody is on it. The winner on healthcare who comes up with the vaccine, not just for California, not just for the United States, but for the world, will create a lot of economic growth. So there's a lot of people really involved in this thing to help this get solved. So what you're hearing about in this recovery is, what kind of shape is it going to take? So you're hearing this alphabet soup of a V recovery, a Z recovery, a U recovery, et cetera. Let me just cover a few of them and kind of talk about what they mean. A V recovery is the one that you hear most about. And this is when the economy, as it did in February, and on March 23rd, the Dow dropped 35%, which was dramatic, to say the least. That's where you get the top to the bottom of the V. And then if we are into recovery, what you're seeing in the stock market, you're seeing kind of a V-shaped beginning. But if we have some pullbacks and setbacks, if we're not able to manage this virus, then we could be perhaps more in an L type of recovery. So this could happen if we have to be quarantined for longer, and if we continually have bad news. The W recovery is a little more complicated, and a lot of people think this is going to happen. This is where the economy and the market tanks. It comes back up, and then there's something that gets in the way, like we can't have as many people back at work. We have to rotate people in, and so then we step backwards in the stock market going down, and then when that kind of gets solved, we see the top of the W happening again. Then there's also a Y recovery, and this is a possible recovery also. And this is when our economy has already been experienced with issues similar to that of recession. Things go way down, we start to go up again, and then we have other issues out there like trade war with China, which is manifesting itself more and more. We have weak manufacturing numbers prior to COVID, and this would make up the downward slant to the Y. And then the market's response would make up the vertical going up. So if we're able to solve these problems, then it could be kind of a Y-shaped type recovery. So, again, all we care about is just getting better and seeing a path forward. But these are the kind of things that you hear about. So let's go now to what's happening in the market. So we'll start with the stock market first. So we're seeing a real recovery in the stock market. You're seeing the S&P 500 getting up to its near high, but is that really a true picture? The fact is that technology is really carrying the S&P 500. The big technology stocks, which I'll talk in a minute about, well, actually the 5 large tech companies like Apple, Amazon, Google, Microsoft, and Facebook are really about 18% of the GDP. They really move, of the S&P 500. And they really move the S&P 500. That's what's really been carrying the market. You take them out, the S&P 500 would not be positive at this point. So we have to kind of take what's happening really in context. The S&P 500, which is the largest 500 stocks, on April the 14th, a record 99% of the S&P 500 traded companies were above their 20-day moving averages. However, in late April, just a couple of weeks later, that number fell 47%. Indicating that market gains are being shared by fewer stocks. In other words, by tech. And tech has been down the past couple of weeks, and that's also affected the market. So we're going to talk about what kind of companies, what kind of sectors to look at, because seriously, the past 10 years, we've been in a bull market. We've had a couple of little hiccups in between, but basically everything has worked. What has worked for the past 10 years may not be working as we go forward in the recovery. We're really going to have to be thinking differently in what sectors we invest in and what companies we invest in, because we're going to have a coronavirus overlay. When we do stock screening, we screen for a lot of things: price to earnings ratio, risk, all kinds of things. But going forward, we're going to have to have a coronavirus overlay to see how these companies are going to be affected by the requirements of the coronavirus. I'll talk more about that in a moment. So it's really peculiar. We have these huge job losses, but the market has been rising. That's kind of surprising to most people. But the reality is the markets are not dictated by logic. The stock market doesn't look at today. The stock market looks out into the future, and they've already written off 2020. and really looking at 2021. And it's making a prediction that we are going to get through the recovery, because people that buy stock in the stock market are objective. They're not emotional. They're buying companies at a low price that they think are going to have future value. And so that's what you're really seeing right now, which is peculiar to a lot of people. Now, one of the things we look at in the market are the price to earnings ratios. So, and that's kind of a factor. So right now, the S&P 500 is trading at about a 20 price to earnings ratio. But if you take those 5 stocks that I just talked about, Amazon, Google, et cetera, their price earning ratio is really 40. They're trading double. They're very, very expensive. And so there's an overvaluation of a lot of the tech stocks, which will be important when we talk about what to do in the recovery. So the market has really recovered unnaturally. It usually takes between 5 and 7 months to recover when the losses are that great, but this has happened really in a matter of a few months. And that's because this is event driven. It has nothing to do structurally at all. So with that, we're going to move to part 4, which is the government's response and what this really means to you. So this is really an important slide that's coming up here. This is a look at the aid package that is now being pushed out to business. The CARES Act was signed into law on March 27th. It's the largest stimulus bill we have ever had, weighing in over $2 trillion. An additional $484 billion of aid was also passed in April of 24. But here's the main points of the March 27th bill. First of all, companies affected by the virus will receive $500 billion in loans and financial assistance. Small businesses, provided that they retain their workers, will receive $350 billion in aid. Now, we all know that this has been delayed, but the money's been committed and it's going through the pipeline. And businesses are suffering until that money's getting there, but it's a lot of liquidity being pushed to individuals and small business. Also, student loan payments that are federally funded can be deferred up to 6 months. They still have to be paid, but they can be deferred. And unemployment insurance, which is really a big thing, will be enhanced by $600 a week. So just think about this. In California, the average unemployment benefit is $480 a month. And it's very tax friendly. You just pay federal tax and you don't pay state tax. But on top of that, the CARES Act adds in another $600. So somebody who is unemployed now can be getting over $1,000 a week, over $4,000 a month. And in many cases, this is more money than they were making before, which is an issue that we'll talk about in a little while. However, this additional $600 is supposed to be ending in August unless it's extended. The government is also offering $198 billion in funds for vaccines and medicine to tackle the virus. And individuals with certain income limits are eligible for up to $1,200 with an additional $500 per child, with the intent that the money be spent. A lot of people have been saving that money and using other funds that they have to bridge themselves until they really need it or until they can find another job. Additionally, Donald Trump has signed a $484 billion stimulus package into law on April 24th. $310 billion of that money was used to replenish the Paycheck Protection Program. That's the additional dollars that was needed. $60 billion for a separate small business emergency loan program and grant program, and $75 billion for hospitals and healthcare providers, and $25 billion for a new coronavirus testing program. On top of that, the House has passed a large bill, and this is when it becomes a political issue, right? The Senate has to vote for this also. So there's another bill out there, and hopefully there will be either all of it or part of it. I think whatever we need to keep this economy going is going to be very, 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 very critical. So getting employees to work is going to be challenging. People are not automatically going to go back to work. People that are getting $4,000 a month are thinking, well, geez, why do I want to go back to work and make $3,000 or $3,500 what I can get for and not work? Plus, I am really, really concerned about contracting the virus. I'm putting myself at risk by going back to work because we don't have a vaccine for this virus. So the crisis gets worse because Americans have become very fearful of public places and returning to work. That's not everybody. Some people are very, very cavalier about it, and we can see that just in our own society right now. And I think that puts us at risk. So Americans fear of both returning to work in large places, that'll continue to hurt the economy. Even as the crisis gets better, people will still be very, very cautious and very fearful. And as people will avoid returning to work and spending money in public places with lots of people in malls and that sort of thing, that'll become a factor. So it's really going to be, it really morphed to a crisis of confidence. People have to be confident to continue to spend money. And again, we're going to be looking at consumer confidence and consumer sentiment as the months go on. Let's move to unemployment benefits for a second here. So this is what I had talked about before. The unemployment benefit is so great, but it is so needed, but it really restricts people from going back to work. The incentive isn't there. So there's going to be a little time lag also in getting people back to fill these jobs that are going to be opening up. Here's 13 important things that you should think about, all of us, the way the stimulus package can help us. Now, hopefully, your financial advisor has been meeting with you a lot, because it's important that you review your portfolio. What you did last year will not be as effective this year. And they should also be talking to you about required minimum distribution. So those of you that are 70 and a half, you may know that every year you have to take a required minimum distribution. This year you don't, you can defer it out. And that's really important that you know this and not take your required minimum distribution, because your assets can grow on a tax deferred basis. So your advisor should be talking to you about that. Also, there are many people that have IRAs and they want to convert that to a Roth. So generally, when you have an IRA and you want to convert to a Roth, you pay taxes at the current level. That allows you to put into a Roth, and your money grows there on a tax-free basis for the rest of your life. So it's really important, because today the tax rates are really low and most portfolios are down. The ideal time to do this would have been, about a month ago when the market was really low. But the cost of converting from an IRA to a Roth is less expensive. So if that's something that you should have happen, your advisor should be talking about this. The most important thing that advisors should be doing for you and you should be thinking about is what is called tax loss harvesting. If you have a taxable account and you own stocks, you know that when you sell something, you have capital gains and you have to pay taxes. We like to try to avoid that. But if you have an actively managed program by an advisor who's on top of it during the year, when you have a gain, they're offsetting that with losses. And now more than ever, if you have a lot of gains, especially people that have held stock for a long period of time, and eventually you're going to sell it, you're going to pay a large capital gain. You can do it today, and you may have other losses in your portfolio that can offset those gains. So this is a very strategic thing. It takes time to do that, but you can increase the yield on your portfolio by around about 1% if it's actively managed. So that's something to go back and talk to your team about. This is also a teaching moment. So, events can happen. We've had a lot of people die as a result of the virus. Hopefully it doesn't happen to anybody on the line here, but it's a teaching moment. We should really have our trusts and our estate plans updated. We should make our decisions now to prevent a lot of chaos down the road in the future. It's also time for charitable giving. There are a lot of not-for-profits that are hurting, and believe me, St. Mary's College, it's a very expensive school to maintain. And they've had pretty good success in fundraising, and that could be a target also for charitable giving, because now we can give more money. The levels of limits of adjusted gross incomes have been raised, which allows us to contribute more money. So entities like St. Mary's College and other food pantry programs, there's a lot of people that are hurting out there. And so, it's a chance to give charitably and also get some deductions for that. Also, I'll quickly mention this, and this is important for those of you that own homes and have loans. Loans have never been cheaper, ever. And so refinancing is really important. So take a look at what your loan rate is. And just as an example, if it's 4%, you're paying over the market. So there's something called a technical refi. You can write this down, technical refi. And you can go back to your lender, and if it's a big bank, it's better. And you can say, look, bank, you're charging me 4%. I'm going to go get a lower loan because I can get 2%, 2.2% on a 30-year fully amortized loan. I want you to lower my rate. I want a rate modification. And so if they agree to do that because they don't want to lose your loan, they're not going to tell you that you're paying too much. But if you go negotiate that, it's called a technical refi. And all it is just signing a paper document. You don't have to go through all the refinancing paperwork and all the expense. And there's very little expense in that. Usually ranges by $1,000, $1,500 to do that. And you also might want to look at just doing a full refinancing of your property also. So those are some of the things that your advisor should be talking to you about. In addition, there should be technical changes made into your portfolio to get you ready for the recovery. That's mission critical. The things that worked the last 10 years may not be working now. And I'm going to go over some of those things in just a moment. But I think one other important point to talk about, which gives us a lot more stability and confidence, if I can move my cursor here. Yeah, is the Federal Reserve is expanding their balance sheet. So the Federal Reserve is really important. We've heard about the CARE Act and all the money coming into business and individuals. We can see that. But behind the scenes, we have the Federal Reserve headed up by Jay Powell. And so when this problem became evident, it took Jay Powell, the Federal Reserve Chief, 2 weeks to act, where they made liquidity and money available. Past Federal Reserve chiefs, including Bernanke and others, it took them months. In 2008, it took the Federal Reserve over 3 months to create liquidity behind the scenes. So Jay Powell has says that he will make liquidity available so the credit markets don't seize up, so money can flow properly, and he'll make unlimited resources available. And we can do that. The United States can do that because the United States is the currency of choice. Oil is traded in US denominated dollars. We're considered to be the safe haven, of course, up to a point. And so we can print more money and it can have its value. It will create problems on the backside, which we'll talk about in a minute. But the stock market likes this because it's an insurance policy that the Federal Reserve is not going to allow this country to go bankrupt. It will print money to make this happen. Now, there's pros and cons to that, but the immediate need now is to keep liquidity into the market. It's an insurance policy, and the stock market, looking out into the forward, likes having an insurance policy. So now the reality is, could the CARES Act create more problems for the future? So as the government has injected money into the economy, the Federal Reserve has purchased over $1 trillion in treasuries and mortgage-backed securities. So this is all debt. This has increased the debt on the backside of our economy. So the fear is that we're going to create inflation, which means that our dollars won't go as far. The fear is that the next generation will have to pay a large bill. If we have inflation, the cost of debt service will be greater. So we're taking care of a problem now, but we could be creating a future problem. And so we need to be thinking about that also in the structure of our portfolios. So taxes. So in 2017, at the end of the year, the new tax act went into effect for 2018, and it's the lowest taxes we've ever paid, and especially for business and also for individuals. But that's not going to last for long because we're going to have to pay for this debt. And so we have to be thinking about, in the future, tax increases and taxes going up. And that's going to affect, how we're able to spend our money and how much money we have to spend. But we can almost guarantee that taxes will go up. Now we're having an election also happen here coming up shortly. That's going to be a factor in the election too. Which candidate is going to, how much are they going to increase taxes? That's what everybody's concerned about. So this will start to raise its ugly head here probably in the next couple of months. So let's conclude with part 5. So we talked about a lot of bad news. We just have to be real and transparent, but there really is a path forward on this whole thing. So there's many things to consider. So let's just take a look at some basic concepts. So you'll probably laugh right now. Buy low and sell high. This is pretty much fundamental basic stuff. But you know what? Really, really hard to do. So think about this. It's March 23rd. The Dow tanks 35%. Really good companies are now trading at a low price to earnings ratio. Your advisor calls you the next day and says, okay, buy low, sell high. We can buy now, and we know the market will recover, and then we can sell high later on. How many of us would really do that? How many of us have the stomach to do that? It's called behavioral finance. And so the common mantra, buy low, sell high, it's really a theory. The strategy is fairly simple. As I mentioned, you purchase stocks at a low price and then sell them at higher prices. Unfortunately, again, implementing that strategy is complicated because emotions and timing really fit into that. So the opportunity to really do that, to get extremely good companies that we know are going to be around that can survive the coronavirus overlay, was really a month or so behind us. But going forward, there still are many, many opportunities of really good companies that we feel will do well through the coronavirus going forward that have a low price to earnings ratio. We'll talk a little bit about that in a second here. So, you know, if you look at the graph here and we look at all the pandemics that have occurred, all the healthcare scares, the markets did tank and they recovered. We even go to a non-pandemic market rebound, and that was 2008. I mean, believe me, people were really desperate in 2008. We really did look like we were moving into a depression. The banks had failed. That's the backbone of our economy. And the S&P 500 was at its worst, down about 42%. Haven't even come near that in this situation. Ended up at about 37%. And it rebounded. And so that's what we really would expect to have happened, is that, you know, you got to invest in good companies, you got to know what you're buying, but you have to put a coronavirus overlay on this particular thing. We have had experience, and I'm sure you have too, with just a couple of months ago, should I get out of the market? And that's entirely the wrong thing to do, and I'll show you some data on that. But anybody that got out when the market tanked 35%, they never recovered. It's impossible to recover because you really don't have a crystal ball. You cannot market time. People try to. You can get lucky, but it's mathematically impossible to do that. So we expect to see a market rebound. We encourage people to, you know, buy and hold, but to tactically adjust their portfolios to, you know, maximize what's going to happen in the recovery. So it's really important. You know, think long term. You got to stick to the plan. You can't do day trading. You can't do what you think is going to work right now. Like right now we're using Zoom, and I'm not suggesting you go buy Zoom. I mean, that's a thing that's good for today, but will it be good long term? And I think when people get back to work, it'll still be a nice little stock, but it's not going to be the one that's going to get really the highest return for you. So I don't know if the recovery is going to be as long as the financial crisis. I don't think so, because we don't have any systemic problems right now. And there really have been, you know, since World War II, there have been 12 bear markets, but the rest have been bull markets. So there's always more bull markets than bear markets. And the bear markets have averaged about 32% down. And they've lasted, you know, on an average of 14.5 months. So you got to think long-term. You have to avoid with your portfolio fear-based decisions. Things have to be done through analytics and research. You have to focus on the long-term. And it's really important to spend time on developing a financial plan that can quantitatively assess your return and your risk. And that can just help you do better over the long term. So a couple of things before we finish here that we want to take a quick look at is you want to consider the effects of COVID-19 in terms of your investments. So if you look at the column on the left, we look at the long-term effects of COVID-19. So globally, not just here in the United States, but there's going to be an increase in debt. The U.S. and international companies are going to be throwing money to keep their economies going. So that's going to create potentially higher interest rates and higher inflation and higher taxes. We got to think about the fact that this globalization thing we've been working on, you know, since World War II may be ending. We are, you know, in disputes with China, but we tend to be more retracting. We had a situation where we had a coronavirus. We needed healthcare supplies. We didn't have them. Other countries were building it for us. We're bringing a lot of our supply chains back. So we just need to be thinking about that when we're doing our investing. And there's going to be a paradigm shift also for businesses. I mean, if you think about this, if in fact businesses have to implement coronavirus overlay into their stores, that means they're going to have fewer sales per hour, few people in a crowded place doing sales, lowering sales per hour. There's a cost to protecting people. And so we really have to be thinking through which companies are going to be less affected by that. So on the right-hand column, just in terms of investing, we want to always look at, you know, high quality companies with strong business balance sheets that are somewhat immune to recessionary forces. We want to look at sectors like consumer staples. Those would be things that we'd want to overweight in our portfolios. Financials and healthcare. There's going to be a ton of spending on healthcare. especially because a spotlight is being put now on the unemployed who don't have health care benefits. And all the people that need to get testing, and all the people that have surgeries and things that have been put on hold. We like but are neutral on consumer or communication services, energy, industrials, materials, real estate, utilities. We like those, but we want to be overweight consumer staples, financials, and healthcare. And we want to underweight discretionary companies that have luxury products. That's not where the money is going to be spent first. And we love technology. We have to hold it in our portfolios, but we're going to be somewhat underweighted in technology because the PE ratios are really high, and these technology companies are really, really expensive. And they've done well because I call them the shelter at home stocks. Amazon, Google, Microsoft, Facebook, and Apple. We love them. But on average, they're trading at about 40 times PEs. But we want to look at more at economy reopening stocks. And there are over 400 stocks that are large cap, mid cap, and small caps that have low PEs, that are name brands of things that are going to do well, that people are going to need when the economy recovers. So that's how we have to be thinking a little bit differently. It's also going to require a lot more research to make smart investment decisions. You know, a lot of people focus on buying the indexes because they're cheaper, the expense ratios are less, and that works really well in an efficient market. In fact, it's probably worked pretty well the last 10 years. But we are entering an inefficient market, and we need more stock picking, and we need more research on which companies to buy. So I'm just telling you, we have to be really cautious about what we're doing. It's our money. We have to protect it so that it really lasts us, you know, the rest of our lives, so that we can be independent. So here's some themes to consider. If you look at basket one, big firms with deep pockets are what we want to look at. So baskets of equities that include firms that are deep enough to handle this temporary bridging that we have to go through, being able to weather the economic impact. Companies that are investable through economic downturns with healthy balance sheets during an economic downturn. They have liquidity, they have a treasury. A lot of companies have built up a big treasury. And then, you know, just good balance sheets that are really important. And of course, we still would include technology. That's really important. And it also allows us to look internationally. The price to earnings ratio on international companies is extremely low and presents an opportunity. And the international, Europe and developing markets are putting a lot of money into their economies to bolster up. And on top of that, our dollar, which has been really expensive, is now getting weaker, is not getting as strong. That benefits Europe and developing markets because they buy oil in US denominated dollars. So there's an opportunity that's kind of occurring that we should look at in terms of us being diversified, not just in the US, not just in growth stocks, because growth is over now for a while. Growth has been going on for 10 years. We should also be looking at value stocks that can pay us some dividends also. So basically, I've covered a lot. I really hope that it's been helpful. I'm sorry that we weren't able to make this interactive, but you know, it's Zoom with a lot of people. But I will say that if anybody has a question, my business partner, Paul, and I, very happy to answer those for you. All you have to do is just email us, or you can call us, give us a day or two to get back to you, and we're happy to answer that. Also, for the St. Mary's group that has participated, we will offer a complimentary stress test of your portfolio. So we can take all of your equities, put it into the black box. That can tell us how we're invested and where our risk is, and if our position is really stress tested for COVID-19 and the recovery that we're about to see. So we're more than happy to do that. And we appreciate you being here. And I think we're ending on time, which is unusual for me. So thank you very much. And I'll let our St. Mary's group conclude. Thank you.
George, thank you from all of us for a timely and thoughtful and detailed presentation. And thanks also to each of you for joining us today. We at St. Mary's are going to be hosting more virtual events, so please stay tuned for event invitations in your email. So thank you very much, everybody, and goodbye.